Hello there, and welcome to Be the Boss of Your Money. It's Mitch Goldberg. I'm a financial advisor with the wealth management firm Client First Strategy. You're watching a quick live episode called Be the Boss of Your Money. My allergies are killing me because I want you to be the boss of your money, not your money to be the boss of you. That can happen very easily, your money becoming the boss of you, and that's what the show is all about. So I want to welcome you. Today's show is all about the big news from the Federal Reserve, which has decided to leave interest rates unchanged through the year 2022. So we shouldn't expect to see a rate increase literally until 2023. That is unbelievable news. I'm going to go over with what that tells us. What are the implications for investors, for millennials, for Gen X, for retirees? And I'm also going to talk to you about what some of the programs are that the Fed's doing. So let's get into it. We're going to roll the introduction, and we're going to roll that now. And we're just going to make this a quick update. Okay, here we go. And we are back. I'm Mitch Goldberg with the wealth management firm Client First Strategy. Today's episode really revolves around the big news. It's the only news today. The Federal Reserve has spoken. They had their two-day meeting, followed today by their Q&A, and their meeting afterward to talk about their programs, their plans, and how the chairman of the Federal Reserve, Jerome Powell, sees things. This is something that I spend a lot of time on. I am I consider myself actually an expert on Fed policy. I consider myself a Fed watcher. This is something that I am very up to date in. I actually spoke, if I may say, a little bragging rights. I spoke with CNBC about this yesterday. I spoke with Money Magazine about this today. And, what this means, what the Fed would have, what the Fed did, I don't think it was unusual to call it to say that the Fed's going to announce no major changes. They're going to continue to be easy with their policies. They're going to keep their lending facilities open. They'll keep buying corporate bonds. They'll, junk bonds. They'll buy everything. They'll buy mortgage-backed securities. The Fed said they're going to continue to buy $40 billion worth of mortgage-backed securities monthly to keep the housing market going and to help out the economy. And the Fed's going to continue to buy $80 billion of treasuries every month. I mean, the amount of money is staggering. This is bigger than what we saw during the Great Recession 11 years ago. So this is just a massive day, a massive announcement. A lot of people thought that after Friday's big jobs announcement, there were 2.5 million jobs created versus expectations of 8 or 9 million jobs lost. People thought that that would change the Fed's positioning and the Fed's viewpoint, but Fed Chair Powell said that they're not going to become overreactive based on one data point. He likes to see a trend. Give him a few months of a trend, and maybe he'll change his tune a little bit, but he's not going to react based on one monthly number. I think we all could agree that that's a pretty prudent way to go. And that's what the Fed's trying to do. They're trying to balance prudence. They're trying to keep the economy going. They're trying to help mitigate the effects of the pandemic. What he talked about is how we went from the lowest unemployment rate, around 3%, the lowest unemployment rate in 50 years, and overnight went to the highest unemployment rate in about 90 years. So it's just really staggering. It's unprecedented. I know these words are these words are overused, but I haven't found any other words to use to describe this. And I am quite the wordsmith, if you know me, so quite a boondoggle. It was okay. So kerfluffle, maybe. So we've got a lot going on. So we're going to go through our update. If you are a watcher of the show, you know that I do an update daily. I'm going to work the news into the update, and we're going to drop off this call in about 10 minutes or less. So let's get with it. We'll do a quick share screen. Share screen. Boom. Here we go. I'm going to move over there into the corner to the side. You see the Dow is down 282 points, down 1%. S&P was down only 0.5%, and the NASDAQ was up today. Why is that? Well, the NASDAQ hit a new record close over 10,000. You know, I remember when the Dow first hit 10,000. That's how long I've been doing this, prior to the year 2000. And, you know, now we've got the NASDAQ above 10,000, and the small cap Russell 2000 index was down a lot. That was down 2.63%. The reason is this. The S&P 500 was not down as much as the Dow or the Russell 2000 because it has a couple of major stocks that have an over influence or an undue influence on the S&P 500. The biggest companies like Amazon, Microsoft, they're hitting and Apple, they're hitting new highs, not just year highs, but new all-time highs. So there are things working out in this market. There's a widely held stocks, certainly over here at Client First Strategy and everywhere else. I know that scares a lot of people because people are worried that if they're so widely owned, that if people start to bail out of them, it takes the whole market down with them. But there's a reason why they're widely owned at the moment. It's because they're secular. They are showing solid, consistent growth metrics, cash generation, regardless of what the surrounding global economy is doing. So these companies continue to grow, and the bigger they get, the bigger their influence is on the S&P 500, because the S&P 500 is market cap weighted. So bigger companies have a bigger impact on the S&P 500 than smaller companies. The Dow is a little different. The Dow is a price weighted index. So companies like Boeing, which went up a lot, are starting to back off a little bit. So the Dow is a little bit more, less of an impact from technology than the S&P. So the Dow took was down almost twice as much percentage-wise, and the Russell 2000 doesn't have Microsoft or Amazon or Apple to pull it up. The Russell 2000 is smaller companies, more economically sensitive companies in that market, in that benchmark. So the NASDAQ was the standout winner today. I don't know if you could see this. I'll make this a little bit bigger on my screen. We'll see how that comes out. Yeah, you should be able to see that pretty good right now, right? Make it even bigger. Look at that. I know you're probably watching this on a smartphone or a tablet, but you see this here. I want to show you the 10-year Treasury is down to 0.735%. So when the Fed said that they're going to keep rates low, the Fed said they basically they see the economy needing a much longer time, at least another year and a half of healing before the Fed could really raise rates. Now, the significant thing about today's presser after the Fed meeting today, okay, is that Powell, as of now, predicts that we'll see GDP down 6.5% for the full year. By the time we get through the fourth quarter of 2020, which, if you think about it, it's not that far away anymore. It's a little over 6 months away. Through the end. So by the time we get to the end of this year, he sees the U.S. economy shrinking by about 6.5%, but he sees a positive GDP in 2021 of 5%. Now, if we do see positive GDP of 5%, I'm not really sure how we could keep rates the same as they are now. We'll have to see if inflation pops up. Inflation is something, look, people have been talking about the end of the bull market in bonds. People have been talking about some cataclysmic disaster in the bond market where interest rates are going to go up, inflation is going to reappear, and it just hasn't happened yet. And apparently the Federal Reserve doesn't see it happening at all over the next year and a half, 2 years, even longer than that. Forward futures contracts, the 5 years, they don't really show any inflation coming up either. Now, that can all change. So that's the story on interest rates. Let's take a look at some of the U.S. market movers. By the way, if you're out there, I'm going to see you. I know there's a few comments out there, and I will address those, but I want to get through the market movers of the day. If you see, look, Salesforce.com, big tech stock, Microsoft up almost 4%, Nvidia up 3.5%, ServiceNow, okay, Electronic Arts up 3%, Clorox up 2.5%. So work from home stocks, tech, big tech, screen stocks, and the food delivery pantry kind of stocks were up today, and decliners were the giant winners of the last 3 or 4 weeks. Norwegian Cruise down 14%. These are on top of yesterday's losses too, by the way. Gap down 11.5%, UAL down, Kohl's down 10%, Carnival, Occidental. These are big losses. Royal Caribbean, Wells Fargo down almost 9%. So we're just basically going from sector rotation here. We saw the opposite for a few weeks. We're going back to that. I shouldn't say we're going back to that. We already did go back to that. Let's take a look at some of the Corona stocks. Zoom up $15, up 7.5%. Clorox up. Activision's, Activision Blizzard make a lot of games. We are a big Activision Blizzard household because we've got the Xbox. Peloton just off a touch, but that's recovered off the 45 level. Domino's up 2.6%. Campbell Soup off just a touch. It's a pantry stock, but what you saw for like a month and a half, 2 months, in terms of the same stocks going up, they backed off. Deep cyclicals like airlines, cruise lines, travel and leisure, retail, those had a nice pop. But now we're going back. We're going back to those stocks that were up before those. And always I take a look at this. This is the number one thing I look at if I ever want to just take a quick glance at the market and get an idea for the internals. And you could do the same thing. Take a look at the Spiders ETFs. They're sector ETFs. There's 11 sectors of the economy, and Spiders, which is owned by State Street, has these very popular ETFs that track each sector of the economy, and that's what I follow. So technology was the leader of the day. It was the only sector to be up today. Healthcare, just about flat. Consumer staples off a touch. It was a generally down day today, so I'm not surprised most benchmarks are down, but communications, utilities are off a little, starting to get off a little more with starting to see the deeper cuts into discretion. But let's go to the bottom. Energy, financials, and industrials. Look, these, energy down 5%. Energy sector, the stock sector, I'm not talking about a price per barrel of oil, just talking about stocks, financials, and industrials. When these stocks lead, when they're up the most, we talk about a V-shaped recovery. That's what we've been getting. And now we're looking at maybe today we're starting to look more like a U-shaped recovery, maybe a W recovery, but it's definitely not a V-day. All right, so I'm going to stop the share screen. I had a conversation with Martha White. She is a writer for mostly for NBC News and then Money Magazine. She writes for the New York Times and other outlets, but she's a pretty well-regarded financial news reporter, and she knows an awful lot about this. And we were talking about retirees and what could they do now that rates are lower. But before we break into that, I just want to check to see who's out there. Hey, Howie, how are you? Do you think the Fed ever raises rates? I know you're being facetious with the word ever, but do I see the Fed raising rates over the next year at this point? If we see inflation, do I think we see inflation then? Not the kind of inflation that would push the Fed to raise rates. I'm not talking about like the inflation when your real estate taxes go up or your healthcare expenses go up, but CPI minus food and energy, no, I don't see the Fed doing anything. And we're back. And will they ever raise it? Hey man, you got me on Facebook and LinkedIn. Kudos to you, Howie. I think you are the first viewer to ever send me messages, comments, questions in both Facebook and LinkedIn. Well, actually, they're both LinkedIn. Never mind, man. I take it back. Okay, so I hope that answer helps. All right. So we've got a few people out there watching the stream, and I really appreciate that very much, by the way. If you have any comments, if you have, I'm not allowed to ask for comments. So if you have any questions, please ask away. I'd love to answer your questions. That to me is the best part of doing this. When you ask questions, I answer them. I really enjoy it. It also gives me good ideas for future content. Words of wisdom, though, and words of encouragement are always appreciated. So the conversation between Martha White and myself was this. I said to her, retirees are just screwed again. It's been the same story for the last 11 years. Fed keeping rates ultra low, and there's no good rates to be had by retirees. The bank pays next to nothing. Anything that is safe to invest in does not pay a good yield. Anything that does pay a good yield is not safe. We saw what happened to pre-retirees, boomers who chased stocks, who got too heavy into stocks. You saw they got just totally smashed when the market went down about 2 months ago. Yeah, sure, they recovered. But if you're in individual stocks, there's a really good chance you have stocks that are nowhere near recovering. The benchmark, the S&P 500, recovered, but that's a different story. That's because it went up on the backs of 6 stocks, FANG plus M. That's Facebook, Amazon, Apple, Netflix, Alphabet, which we use the G for Google, and FANG, and the M is for Microsoft. But those aren't really like major dividend payers. And how much of those same stocks can you have in your portfolio? Granted, if you had a ton of those stocks, like even a disproportionately large amount of those stocks, you'd be very happy today. But that's really a risky thing to do for most people. And that talks to concentration risk in just the tech/communication sector. And we like to diversify. And diversification, that's a strategy that we use to minimize risk, but it doesn't necessarily protect your portfolio from going down in a generally down market, as I'm sure you know. So I think this hurts retirees the most because think about it. If you're retired, you're going to retire. Presumably, your time horizon for your financial goals is a lot closer. So that means your risk tolerance is lower. So you can't have as much money in risky stocks. And if you have to sell stocks into a down market, you run the risk of poor sequence of returns. That means it's just harder to bounce back when the market does go back up, because when you sell more shares when the market's lower, you have fewer shares working for you in a recovery. So it's harder to recover. Negative sequence of returns is what that is called. And then, you have people chasing for dividends. But, an example of a stock that's down a lot that people thought was a great dividend payer was AT&T. And I actually think that the ability of AT&T to pay their dividend is somewhat questionable. So that's why retirees continue to get screwed. I mean, literally, you could take my quotes about the bond market, what Chair Powell said. You could take my quotes from Bernanke. You could take them from Yellen, and just even Greenspan. Just recycle the same quotes, because it's the same old story. The Fed has gotten easier. They've expanded their balance sheet even more. They continue to expand their balance sheet. So it's amazing how we're just in the same old for the last 11 years. So with everybody wringing their hands, interest rates are lower. It's good for mortgage borrowers. It's good for people who already have assets. Like if you're a retiree and you have a lot of assets, you have a lot of money in the stock market or a lot of money in real estate, then lower rates are good for you because it helps maintain high values. But if you're somebody who needs to live off of interest and you need to buy fixed income, you need to keep your money in cash equivalents like savings accounts, money market CDs, you're really screwed. It's been like that for years, and it's continuing to be like that for at least another, for another 2.5 years, according to what the Fed said today. They could change their mind, but even if rates go up, how high can they go up? And if you overindulge in high yield stocks and high yield bonds and rates go up a lot, well, then you have to worry about the valuation of those assets, because those assets typically do poorly when rates go up a lot. So there's not a lot of good news today for boomers. There is some good news for millennials and zillennials in terms of stocks are the only place to go. And if you're looking for mortgage or credit, at least you're getting that on the cheap. So that's the news today. All right. If you have any questions after this, hit me up in the live stream. I love answering your questions. If you watch this in the replay, welcome to you. I'd love to answer your questions. So hit me up in the comments, just like you're watching it in the live, and I will definitely see those. All right. My wife and I are going out to dinner now. It's the first time we're going out to dinner in months. There's outdoor seating today allowed in the state of New York just today. So we're going up to Prime. That's in the village of Huntington on the water in the Long Island Sound. You get these great views of Long Island and Connecticut, and can't wait to go. So we're leaving in about 10 minutes. I'll see you later. Bye.